Start.
Dear students, I welcome you to the course on banking. In this course, we shall study Indian financial system, commercial banks, deposit mobilization, credit creation, various types of loans, rural banking, current issues regarding banking like NPA, and recent trends on banking. This course will help you in preparing for a career in banking sector. Today, in the first session, we shall discuss about Indian financial system. When we talk about Indian financial system, we are talking about the system which facilitate transfer of money from those who have excess money to those who are in need of money. This system enables people to deposit their surplus money, and those who need money for productive purpose, they can acquire money from Indian financial system. So when we talk about Indian financial system, broadly we have two categories, formal and informal. When we talk about formal system, we are talking about the system which is regulated, disciplined, well organized, controlled and monitored by the government. When we talk about informal sector, it is a sector which is not regulated one. It has been working for years, but it is not having any direct control by the government. Now when we talk about formal system, we are having various players. For example, we have regulators, we have banking institutions, we have financial markets, we have financial intermediaries, we have financial instruments, we have other players in the market. These are all regulated. Now let's talk about financial regulators. The Ministry of Finance, the Reserve Bank of India, SEBI, these are important regulators of the Indian financial system. Reserve Bank of India frames guidelines. The Government of India prepares monetary policy, which is announced twice a year, and this creates the benchmark for financial institutions. So now let's talk about financial institutions. We have various financial institutions which are working in our country. These financial institutions work under supervision of Reserve Bank of India. These financial institutions create a mechanism for transfer of financial resources from those who have surplus financial resources to those who need financial resources. The easiest financial institution to access is bank. You can find a bank even in remote rural areas. Banks try to take deposits from people, and they have what we call as various types of savings schemes. Any person can go to a bank, deposit the money. These deposits compile and create huge financial resource. Bank provide loans to industries, firms, companies, farmers, so that they can use money in productive sectors. Thus, small deposits pile up to huge financial resources for the development of our country. When we talk about financial institutions, we have four types of financial institutions: banking, non-banking financial companies, mutual funds, insurance companies, and other institutions. Banking, again, various types of banks are there. For example, rural banks, which are operating mostly in rural areas. When we talk about banks, we come to know that banks operate in a very systematic manner, and The working of the bank is as per the regulations of Reserve Bank of India. Banks work for the purpose of deposit mobilization, credit creation, and banks earn some earnings in the process. I'll give you a small example to illustrate the point. An investor deposits money in a bank. Now suppose the bank gives that person interest at the rate of 6%. The bank is having hundreds of depositors like him. The money compiled generates big money. This money is given by the bank as loan to industries. Now suppose the bank here gives the loan at the interest rate of 14%. Now you can see the bank is paying 6% but charging 14%. There is a difference of 8%. This difference constitutes the earnings of the bank, operating expenses of the bank, the administration expenses of the bank. So in this way, the bank is able to earn profit. The bank is providing services to the industries because they require financial resources they are able to get from the bank, and the bank is providing financial services to the small investors who want safety and security of their money, and they are able to get the money deposited in a bank. Whenever they need money back, they can take the money back from the bank. Non-banking financial institutions. Non-banking financial institutions, or NBFCs, are those institutions which are also regulated by Reserve Bank of India. They operate on various schemes. They operate various schemes to mobilize small savings of the people, and they provide lending to the bank, to the institutions, industries also. NBFCs come up with various types of schemes which are regulated by Reserve Bank of India. Now we will talk about mutual funds. It's again another method to mobilize small savings for industrial development of the country. Mutual funds can be again private sector mutual funds, public sector mutual funds. A person can invest small money in a mutual fund. Mutual fund collects these money and invest in stock markets. And in this way, they are able to earn money for themselves. Whatever income is there, they return back to the investors after deducting their administrative expenses. I'll give you an example. Suppose 100 people find some savings with them. They invest in mutual funds. Each one of them invests, let's say, 1000 rupees. So that way, mutual fund is having now 1 lakh rupees. Now mutual fund will invest this 1 lakh rupees into stock markets. Now the stock markets give two types of returns. One is in the form of dividends and another is in the form of capital appreciation. Capital appreciation means, suppose you invest in a stock market when the share price is 100 rupees. Later on, when you withdraw the money, the share prices have gone to, let's say, 120 rupees. So you are able to get return of 20%. So mutual funds invest the money very carefully in good companies in stock markets. And they have professional analysts who keep on monitoring the working of the stock markets. The mutual funds